Rob Lustrin is going to be taking us home here. He heads up Reed Smith's New York-based shipping capital markets team. Having advised shipping and offshore industry clients and corporate and U.S. security law matters for more than 2 decades. In particular, Rob has represented shipping companies around the world, including numerous dry bulk shipping companies. Capital market security offerings such as IPOs, SPACs, high-yield bonds, and convertibles, as well as business combinations and going private transactions. A word about Reed Smith: more than 1,700 lawyers and 29 offices worldwide, including New York, London, Singapore, and other major shipping centers around the world. The big finish, Rob.
Thanks, Mike, and thanks to the entire Marine Money team for making this day possible. It's terrific to see so many of our friends and colleagues here live and in person. So, very excited for our panel. The dry bulk market has risen up from historic lows in the middle part of 2020. Let's just say, in the middle part of 2020, during the height of the pandemic, to the highest levels that we've seen since around 2008. And as you all know, this has been one of the hottest shipping sectors alongside the container shipping sector this year. And the dry bulk companies represented here today have seen some blockbuster earnings, announced newsworthy dividends, and more recently, however, the charter rates as reflected by the BDI and other metrics appear to be declining over the past few weeks. In fact, yesterday's news reported that over the last 5 days, but it was prior to yesterday, the decline in the BDI puts it at its lowest level since June of 2021. And just want to let you know, we have a truly great panel here to help us out. Star-studded panel, I might add. Some of the most prominent publicly listed dry bulk companies in the world. All of them here today with NASDAQ listings. And I'll introduce them. Starting from my left, we have Hamish Norton, is the president of Star Bulk. Gary Vogel, the CEO of Eagle Bulk. Tsantanis, the chairman and CEO of Seanergy Maritime. And Tasos Aslidis, the CFO of both EuroDry and Euroseas. I think we'll focus on EuroDry for this panel. Tasos, if you don't mind. Gentlemen, it's an honor for me to share the stage with you. And my first question relates to some of my earlier thoughts on market dynamics, particularly the strong third quarter earnings as a backdrop to the recently reported declines in charter rates. What do you feel the state of the dry bulk sector, and where do you think your company fits in the mix? And we'll start with Hamish, sure. To my immediate left.
People are focused on the amount by which the dry bulk indices have fallen since the peak they recently hit. But if you look at the absolute level of the dry bulk markets, it's really good. Based upon any sort of historical numbers we've seen, over the last 10 years, we're making a lot of money, and everybody should be happy. And as I said on our earnings call, it gives us warm and fuzzy feelings to distribute dividends to needy shareholders at Christmas time, as it will do. I think basically, rather than being afraid because of the drop, people should be thrilled at the underlying strength of the market, which is this strong, even though China has taken on fewer dry bulk imports this year than last. So it's the rest of the world that's causing this upturn.
Gary, some thoughts?
Yeah, I agree with what Hamish is saying, and if I drill down even further, we're in a unique spot in that we're invested in the mid-size of dry bulk, and our market was only as high as 40, and now is at 25. And for a company like Eagle with assets that cost about half as much as Capesize, 25,000 is even that much more demonstrative in terms of revenue. On our investor deck with some very high level assumptions, $25,000 market on an annualized basis is about 350 million EBITDA. So to Hamish's point, this is really, really meaningful. And on top of it, I would say, as strong as dry bulk's been, it's really been led by the minor bulks this year. And for assets that cost half as much, minor bulks, where we derive 2/3 of our cargo demand from, has led dry bulk at 5%, and next year is expected to lead as well. So Dry bulk overall is really healthy, but I'm really think to be in that mid-sized segment, especially with infrastructure spend, is really a good place to be. So that's where we feel we fit in the mix.
Thanks, Gary. Stamatis, you're up next.
Well, I agree with both Hamish and Gary, of course. It's been a great year so far. If someone told the investors last year that you will be seeing year-to-date figures at $35,000 for the Cape sizes, I mean, that would be an amazing prospect. No one. It's been a good year so far. I think it's a preview as to what we're going to see in the next few years at prelude. We'll see a much higher market from 22, 23 and onwards for various reasons that we will analyze on this panel. We specialize in the Cape size segment, only Cape sizes, for a particular reason that it has been the partnerships with some of the world's largest miners. And these partnerships are not only commercial partnerships, but also ESG partnerships with prices and all that. So this is how we have positioned the company, and we will keep it, very clean, very simple as much as we can for the following years.
And last but not least,
I
Tasos.
think it's very hard to add anything to the comments of my colleagues here said. It's good to see the dry bulk market being strong across the board, from the minor bulks and also to the iron ore and even coal sector. Although probably this weakness at the end of the year has to do more with the steel industry and the certain issues that have developed in China. But I think that provides a significant support to the greater support, and I'm sure we'll talk shortly about it, that supply side provides to the dry bulk market. That is alone provides a lot of optimism, at least for me, to look at the sector.
Thank you, Tasos. In fact, you just segued into my next topic, which is really on the supply side. We see some high demand for transportation of dry bulk commodities across the various spectrum of commodities. And yet there seems to be little new tonnage coming on board, obviously, which is very nice. And do you see this as a formula for continued strength in the dry bulk market? And is this stable tonnage and lack of new supply coming on board, is this changing the cargo mix, do you think, that are being carried by the vessels? And how does this interplay really with the container shipping market to a lesser extent? And that's, I think, something that people are thinking about. I know it's a loaded question. Anyone want to tackle that?
Yeah, I'm happy to.
Okay.
So, I mean, sure, lack of new buildings is definitely part of the secret sauce to a strong market. I think there's a number of reasons. It was discussed on an earlier panel, right, that yards are quite busy, particularly building container ships, which are typically larger, complex, take a long time to build. In addition, the dry bulk, the secondhand assets are simply more attractive from a return standpoint. You put $10 million of net income in the bank before that new building will hit the water, and that new building is priced still significantly higher. So, not to mention, not to get too far ahead, but the tail risk of a new building delivering in 2024 is only going to be 11 years old in 2035. The decarbonization uncertainty around the pricing of carbon is quite extraordinary. So, I mean, we wouldn't go near a new building. People who know me know I wouldn't go near a new building previously because there were too many ships. Now I'm pivoting to the rationale, but the end result's the same. We just don't think there's a reason to go out and order ships. I'll let someone else answer the other part of the question.
Yeah, I mean, I guess I would agree with everything that Gary has said. I mean, basically, the more regulations around decarbonization, the better for the dry bulk industry. I mean, basically, what we want are strong, consistent regulations that are more or less as tough as possible. Because basically that will force people to not order ships until the ship that meets the regulation is available. And that's certainly not available now.
Yeah, and it's the first time in recent history that you have such a discipline in new building order book, and that discipline is not because everybody just sat down and decided not to build ships, but it's environmentally imposed discipline. Like Gary and Amy said, you don't know what that ship is going to look like 5-10 years years down the road. You don't want it to be redundant or obsolete or anything like that. So discipline is good, and when it derives from environmental reasons, that's even better. So that's what it is.
And I don't mean to take Tasos time, but just also the stronger the regulations around decarbonization in the intermediate stages, the slower the fleet will travel. Because by going a little bit slower, you burn a lot less fuel, so there will be pressure to go slow, and going slower means basically less carrying capacity and a tighter market. So it's an unmitigated good as far as we can tell.
That is correct. And if there is a single factor that can create explosive growth in market rates, is the supply side, because the supply is inelastic. If there is a very tight supply, small increases in demand really send the rates through the roof. I've been working with numbers and data in the dry bulk market for the last 30 years. There has never been a time with such a low order book for so long a time. Since the beginning of the year, even before, it is stuck around 6%, 6 to 7%. So that has been unprecedented. So that provides, and given the fact that the shipyards are scheduled to deliver vessels of other sectors, that provides a solid foundation for minimal supply growth over the next 2 years. In addition to the reasons that Hamish is mentioning, the supply effectively will come down because of the slowdown.
Well, let me ask you a question, since you're obviously CFO of both EuroDry and Euroseas, so you're seeing the dichotomy between the dry bulk market and the container shipping market. Do you feel that the dry bulk vessels and the container shipping vessels, in light of the fact that in both sectors there seems to be the same issue with a supply side crunch, do you see any competition starting to form between, say, smaller container ships and smaller dry bulk vessels?
There is some anecdotal evidence that, or rumor that certain bulkers are taking container ships, but I cannot confirm a wide trend, nor I see one.
I mean, what we see to some extent are cargoes that can travel in containers and usually travel in containers are somewhat moving towards small dry bulk vessels, particularly handy-sized dry bulk vessels. And we are noticing that some open hatch handy-sized vessels have been carrying some containers, but there is some support to the smaller ship sizes from the container market, and the smaller ship sizes are then in turn supported.
That's why they've done a little better.
Yeah.
Perhaps as well.
Yeah.
What is more striking is the different ordering patterns on the container ship versus the dry bulk sector. In the container ship sector, I guess because liner companies need the ships, they took the bold step to place the orders. Container ship order book more than doubled since the beginning of the year, where dry bulk has remained stagnant. And that is a striking thing to observe, to notice.
I think the container lines are afraid of their customers if they didn't order new buildings. And the last time a dry bulk owner was afraid of his customer, it was for different reasons.
Well, I'm glad to see that no one is itching to build new ships, so that's very nice for the dry bulk sector. One of the things that also, I guess, in a related question that I have, which I just thought of, is back in kind of the earlier days when there was a lot of tanker new buildings and there wasn't a lot of dry bulk new buildings, the shipyards were really trying to keep their knowledge and know-how in constructing dry bulk vessels. So they would, ask some of the companies to order a dry bulk vessel alongside several tankers. Do you see that same type of thing happening? Are you being approached by shipyards who are trying to entice you to build vessels just because they want to keep their know-how in doing so?
Well, I don't think there's any company that has not been approached by a shipyard to build the new ships. And I mean, at least we have not been offered a bonus ship on the side, like a different type, so we can
Like,
test
you
it.
know, build a couple of dry bulk vessels and maybe do a PSV or
but
something.
it's actually very surprising to see how far behind the shipyards still are in respect of what is supposed to be the vessel of tomorrow. I mean, they're offering something that costs almost double a 5 or a 10-year-old ship, and that is not even ready for 2030 or 2035. So it's striking to find out what's the rationale behind it, but well, that's what it is. I mean, we just say no, so this is what counts.
Let me just shift gears a little bit here. We've been reading in the news a lot about the global energy. I wouldn't call it a crisis, but certainly there is a global shortage of energy, and this has resulted in maybe higher bunker prices, higher oil prices, and the like. With some countries are returning to coal, and I know Stamatis has been very vocal and has been reported in the news as being on board with. I should say on board. That's really the wrong term. But you have predicted that there would be more coal carriage voyages over time. I mean, how do we see this playing out? And also with the global energy issue, I guess it's bringing the bunker prices up, and how is that really filtering into your business? And I'll let Stamatis take that first because he's the coal guy.
But I'm not the coal guy.
He's the coal guy.
What we said is that, like a few years ago, about 10 to 20% of our cargoes were coal. Right now it's 50 to 60%. So you see a big coal re-emergence happening, and the a lot of coal cargoes going to Europe for obvious reasons, and the world needs energy, which cannot be replaced, unfortunately, yet by the Scorpio ships or whatever else. So you still need a lot of coal. Also, let us not forget that in 2022, nuclear power in Germany is going to go offline, and that's going to be replaced again by coal. That's 11% of Germany's energy out there. So we have a lot of coal cargoes. They don't fill up the whole ship. I mean, we just 5,000 tons of coal cargoes, and we do that all the time, crossing the Panama Canal frequently.
Thank you. Anyone have a further comment on this, especially in light of ESG?
Yeah, I mean, there's such dislocation going on right now, right? So clearly we're in a situation where we are carrying bad cargoes, spillover cargoes from the container, right? You see need for coal short term because of this, energy crisis, if you want to call it that. Long term, I think we all agree that coal is going to continue to decline long term. But it's these dislocations, and the biggest one, of course, is China-Australia dispute, where all of a sudden, we never carry met coal. We're not really in met coal almost at all, and now we've carried met coal from the U.S. To China, which is an incredibly long haul. So at the moment, there's a lot of dynamics going on in many commodities that aren't, call it normal. Stealing the word of the year, transitory. It's transitory. The question is, what does that mean, right? Are we talking another 6 months, or are we talking longer here? But I think long term, going back to trend lines on these things is what we would expect to have.
Yeah, and of course, coal in 20 years is going to be probably an unimportant or maybe completely unimportant commodity, but that's 20 years. And the ships that are in the water today won't be in the water in 20 years, and the market will have time to adjust. In the meantime, we actually see we believe coal will be a growing commodity in the next very few years. It's part of the mix.
Right, so in the short term, due to a dislocation, as Mas was saying, it seems like this has partly been driving the demand for tonnage.
Yeah.
Okay. So just looking forward, maybe a little bit further, I mean, how do we perceive charter rates and vessel values in light of the fact that the mix of bulk cargoes will be changing? And I think over time, it is correct that there will be less and less consumption of, say, coal. But yet, iron ore, of course, will always be something that is very important to growth, especially when you have, growing economies around the world. What do you? I hate to ask you to predict, but what do you think will happen going forward, past a 2 or 3 year window, maybe out 8 to 10 years or something of this nature?
So to Hamish's point, he said, the dry bulk market will adjust to that future cargo mix and even a zero coal world 20 plus years from now. The question really is whether we're going to do it prospectively or build too many ships and then do it, right? History doesn't look kindly upon that analysis, but hopefully looking forward, it's so clear that that's where we are going in the future, not in the next 1-2 years, that the industry will look and adjust new buildings such that it picks up for that cargo mix. I mean, we're fortunate in that the minor bulks are so much more broad, both in terms of commodity and in geography spread, that the change in that cargo mix isn't as meaningful because we pivot all the time. Our cargo mixes go up and down, grains come in seasonally, things like that. So it's a little different depending on what part of the segment within dry bulk you're talking about.
I think it's also important if you're talking about long term, exactly, you have to take into account the supply side developments. Right? You cannot talk only about demand and what's happening in demand. On the other hand, in the near term, the supply factor, as I mentioned earlier, is such strong that it sort of covers and overtakes the bunker price increases and all the changes in demand. So it's a very funny situation. Supply is important in both near term and long term for very different reasons.
And I think that regulation is going to play a big role in basically the management of the supply of ships, because historically the dry bulk business has been a business of small companies operating with very lean management teams and not dealing with a lot of difficult regulation. And I think the world is becoming a much more regulated place. I think the rest of the world is going to look more and more like the European Union in terms of regulation, and the companies are going to have to deal with very high regulatory overheads. That means big companies, that means a much more, let's say, organized approach to the industry, and when you've got an organized approach to the industry, that leads to people being able to limit their ordering. It inevitably means less competition among the industry players.
I will just add to that. I do agree that going forward, the environmental regulations are a huge friend to the potential of keeping ordering, because the capital requirements are going to be so great. It's not going to be business as usual. So that's really positive for dry bulk long term.
Thank you for that. Why don't we just turn a little bit to chartering strategy, and maybe each of you can comment a little bit on your views as to fixing charters long term versus short term, and getting back on what we touched on earlier, whether the changing cargoes, particularly in the backhaul trades, whether that is figuring into your chartering strategy.
Well, all of our fleet is fixed on period charters, and for us, that commercial decision is not just because we want to have the certainty of revenues or whatever that is, but it derives from the need that we have set commercial agreements and ESG partnerships with our charters. We are pioneers in that field, having installed energy-saving devices paid by our charters on both of our ships since 2018 and 19. So we've been in that game for so long. We will continue doing so. We see more and more charters these days willing to commit in period deals that are associated with ESG standards as well, which means we take your ship, but we're also paying for the installation of energy-saving devices in connection with what's that going to be. So in a sense, you're getting this partnership agreement more broad and more widened than what it used to be. Because, like Hamish said before, it requires a huge overhead, but if you do it together with conglomerates like the Cargills or whoever else in the world, it really helps the passage of know-how from one side to the other. We've done it very successfully, and we will continue doing so.
How much time can I talk about chartering strategy? No, I mean, it's exactly, that's what we're an active owner operator. So, I mean, just to talk about backhaul, typically backhaul which for us is Asia into the Atlantic, it trades at about 25%, broadly speaking, of the index. This year it's on parity, right? So, I mean, every day we come in the office and ask ourselves, what's the best deployment of that asset in terms of backhaul versus where the next market. Grain, as I mentioned, is a huge driver in the South American grain season in the second into third quarter, and North America in the fourth quarter. So the answer is yes. In terms of strategy, we prefer to use derivatives to hedge our cash flows because we can do it dynamically, right? So we can sell derivatives when the market's strong and then pull back. We can unwind those hedges, monetize them, and put ourselves more exposed to the market. Also, when you lease a ship out on a time charter for a year, you're giving away typically a 3-month option at the end. So in a weak market, you're going to get that ship back on the early days, and in a high market at the end, or even longer, and then come get the difference and call your favorite law firm. So in that regard, the answer is we're actively engaged in the market, all with the goal to outperform the benchmark indices.
Yeah, and we're actually pretty optimistic about the near future of dry bulk charter rates, and if what we expect will probably fix out a little bit, not too long, covering maybe some ships in the first half, maybe more than we've got, but I think long-term chartering of ships goes hand in hand with high debt levels. If you have high debt levels, you need the long-term charter. If you're chartering out long, you need high debt levels to generate good return on assets. And I think debt is going to be harder and harder to get in the dry bulk business. The European shipping banks love to lend against dry bulk ships. The bankers do anyway, but their shareholders are saying, these ships carry coal sometimes. And, these ships are fueled by fuel oil, if you can even call that stuff fuel oil. And so banks are going to have a harder and harder time lending. And so I think the less one depends on leverage, the better off one is in dry bulk. And that argues toward a more spot-oriented chartering strategy as well.
We're trying also to have a balanced strategy, trying to get on charters sufficient percentage of our tonnage to cover our costs and play the remaining on the spot market, on the shorter market. I think Gary is very right. If you do time charters, you typically give out an option at the end of the charter, which is a cost we do, and you can moderate a bit the spot market using the derivatives as Gary mentioned.
Okay, well, we touched on a lot of different topics thus far, and I think we ought to speak a little bit about the theme of the day, decarbonization. I know we've touched on it a little bit here, but maybe we can have each of you discuss what's your decarbonization strategy. Do you think that the current IMO targets are realistic and are achievable? And the new building order book remains very, very low. Is that because of the stranded asset risk that dry bulk owners were concerned about, or is there something different going on? And why don't we start with Hamish here?
Okay. Well, look. First of all, I think the new building order book is low not just because of the stranded asset risk, but because, as Gary said, existing ships in the water are just financially more attractive than new buildings right now. But basically, the IMO targets they're going to be very challenging to achieve. Nevertheless, I think one wants to have those targets or more ambitious targets. But in order to achieve those targets, the world has to create a situation where somebody who comes up with a technology that helps gets rich. And right now, they don't get rich, despite Hal Malone's, efforts, which are to be praised. You don't have the incentives to create decarbonizing technologies the way you need. There has to be, or some other economic driver to get people to make money by decarbonizing.
Yeah, I mean, well, first I'll talk, our strategy, our focus right now is to make our ships as efficient as possible, right? So whether that's retrofitting, fuel-saving devices, low friction hull coatings, advanced weather routing, things like that. And there's two aspects. First of all, of course, it's to save carbon emissions. It's also important that the ship of the future uses as little fuel as possible, even though it's zero emission. Molecular density and also cost of these fuels. So the less you're using, obviously, will make the transition for the industry, easier. Is the IMO target, 2030 is absolutely achievable with what we have now through devices, things I mentioned, and slowing down. 2050, I think the bigger question isn't that going to get ratcheted up, right? 50% by 2050, I think is yesterday's news, right? So, and I think the answer is it can, but to Hamish's point, it's about putting the right framework in place, carbon pricing, the incentives, so that first movers are paid for the incremental cost, right? And also to support the fuel supply chain. Our ships call on hundreds of ports a year, so we couldn't even be first movers in that regard if we wanted. It's going to start with, of course, liners, ferries, ships that are predictable in terms of their schedules and things like that, and then go from there. But the answer, I do think it's achievable, but there's a lot of work to be done, and I am encouraged by the collaboration going on.
Well, we have started installing energy-saving devices for years now. We have installed artificial intelligence on board of our ships. We've done everything right. We're now testing biofuels in 2 different cases, and that's a trend that we see expanding more and more, assuming availability of these additional fuels. I'm not so sure that the IMO targets will be met. In 2026, when the whole thing is going to be revised again, people will realize that the cost of transportation will increase at such high levels that it's going to make it impossible. You're going to pay a big percentage of the delivered good in transportation costs, so that will need to be revised in a way. So we're doing whatever we can, whatever is possible on the existing fleet, but let us not forget that 2/3 of the dry bulk fleet has been built 2012 and previous years. So, in a few years, all of the ships will be 15 years or older. This is surely not a super eco fleet. And in some cases, it's going to be a very, very polluting, fleet in some particular age groups, in some particular shipyards. So, let's wait to see what happens. But my guess is that in the next 2 or 3 years, that the EEXI and the CII is going to be tested in full. You will see such big speed reduction that the availability of supply in the water is going to be problematic, for the consumer. So that's going to be the big test case.
I'll answer the question from an investment strategy point of view. Our fleet has 2 clusters. An eco cluster that includes new buildings, vessels that we built ourselves, or very young ships, relatively young ships that we bought, and has a cluster that has Japanese-built Panamaxes in the early 2000s. By the time these regulations kick in 2024, 2025, the older cluster will be almost gone through his life, will be almost 25 years old. So we'll be able to, if we can make it conform with the new regulations, it's an option for us to continue using it. Otherwise, it will take the usual route. The eco ships, the younger ships, very likely will continue being around, and we hope that we can use the earnings to accumulate to replace the ships that will go and continue being in the dry bulk markets.
Thanks very much. I think we're just about out of time. Do I have time for one more quick question? Okay, one more quick question. Obviously, any solution here is going to be highly capital intensive. Where do you see the most lucrative source of capital coming from I don't know if it's in the short term, but certainly during this period, you're going to need a fair amount of capital. So.
I think it's our job to convince the shareholders that their equity is earning a really good rate of return in this business, and as a result, create an attractive equity market for the right dry bulk companies. That's why you have a public company. And that's really what we're trying to do is persuade the shareholders that we are a good steward of their capital and they should be wanting to invest in us. And frankly, the rates of return that will be possible on some zero carbon ship designs we've looked at are really high, we think.
You all agree?
Yeah, well, I think, for us, as I mentioned in the mid-size, I think we're years away from being in a position to renew the fleet with any ship with zero emission fueled ships. So I think our job at the moment is be good stewards of capital, right? Maximize the efficiency of our fleet, show discipline so that when we're in a position, right, and obviously have a strong balance sheet, so when we're in a position to go out and make these investments, and they need to be compelling investments, that the equity wants to be there to support it based on the track record of how we've been stewards of capital looking backward.
Well, I agree. The best source of capital is coming from the organic cash flows that the companies will be generating, and I think that being good stewards to our shareholders, we will be needed to return as much as we can back to its source, its original source.
I agree also. Organic cash flows is for once a tool that we have to invest in shipping, but it's a cyclical industry. In a cyclical industry, it's hard to have permanent sources of capital. It will be debt, hopefully will be there always, because that has been continuously the supporter of investments in dry bulk, and equity as circumstances permit.
I'd like to thank all of you. That was a terrific panel. Thank you to the money folks.